So in this video, we're going to cover where algorithmic trading fits into your portfolio and the expectations that you should have if you were to work with us here at Algo Alpha. Now, this is going to be an educational video regarding algorithms in your portfolio, so we must cover some disclaimers. We are not investment advisors, tax advisors, legal advisors, or financial advisors. Trading in markets carries risks, and you can read these further disclosures in your own time. So let's go over the traditional market approach. And this is what most investors typically find themselves allocated in. It's something called the modern portfolio theory. And if you're an investor, you probably already know the traditional framework has been to allocate capital across stocks, bonds, and some cash. Now, this was very popularized over the past few decades and has been what most people have been allocated to for years without even knowing it. But the main problem is as time has gone on, the portfolio may have grown, but our US dollars have declined in value, and that has continued to accelerate at a rapid rate. So if you see your accounts going up in value, but you don't feel more wealthy, it's because we've continuously printed about 7 to 8% a year when it relates to the US dollar. And as the government prints more money, and as the world starts to see the US continue to print more money, the dollar continues to depreciate. In 2025, it went down over 10%. In 2024, it also went down over 10%. And that's not including the COVID print, which was over 40% of all US dollars were printed within 18 months. So all assets are going up that are dollar denominated, but it may not actually feel that you're actually becoming wealthier because the cost of living is also going up as well. So the question that investors are asking themselves now is where to go and where to look as it relates to creating a better performance than the government debasement of currency. Now, we look at today's markets nowadays and things have rapidly evolved. Historically, the stock market would have to have an innovative company that people would invest into, and that would actually be what helps them outperform their assets. There are still opportunities. I'm not saying that there aren't opportunities, but that has been the historical way to do so. They've also looked to allocate to crypto. But as things have emerged, there are a lot of players, a lot of new coins, and a lot of new projects that are coming online. So it's hard for a lot of people to actually find the signal relative to all the noise. And that's where we go into the behemoth industry of Forex and commodities. Now, they operate very differently than stocks and crypto because they historically have been susceptible to the changes in politics, central bank policies, and other capital arbitrages that are done at a global scale. And so, with all the above being true, markets have rapidly evolved and algorithms are now helping investors take over the daily participation to spot a lot of these moves. And if you are unaware, about 60 to 80% of all activity in the markets is now ran or largely influenced by trading algorithms. And so that leads us to how do you actually get access? Well, banks and institutions have known this for a long time because their business is to make more money on the money than they actually give you. Their entire business model is built on NIM or net interest margin. So they may pay you up to 3% while they're making 10, 20, 30 plus percent on your money. And one of the strategies that they hold for their private individuals and wealthy clients is trade desks. And this is where Algo Alpha thrives. See, we built Algo Alpha to provide investors access to trading algorithms with proven track record and a proven strategy. Now, our strategies are not only third-party platform verified, but also third-party CPA verified, where they review the trading strategies and actually sign off on the performance. So what you see is what you get. Now, when we talk about evaluating the strategies that you have through your capital, you have to understand your risk and your reward. And so, like all financial decisions, your risk tolerance is going to be different than anyone else. The higher reward that you're looking to achieve, you will have to stomach higher volatility. And so, many of our users come to us knowing that they have a higher return profile. They understand drawdown, they understand the stomach that they might have, but all users have a different experience. So, if we just cover the risk curve, very low risk strategies include holding your money in the bank, cash or a checking account. Now, checking accounts obviously don't pay anything. The money is being printed on average at 7% every single year. So you're actually losing money by holding cash. Bonds have historically paid between 4 and 5% in recent market environment. And so even if they're printing at 7%, you're not fully, making money. You're still below the waterline. And that's where we actually get into some of the other financial markets like the S&P or like the NASDAQ or other included stocks in emerging markets. Those will give you between 10 to 20% per year. But again, those aren't going to be the things that will generate you the higher returns unless you're manually trading, because most people do not have the time to do so. This is where the world of alternative assets really starts. So by participating in alternative strategies, you are essentially stating that you are okay with more higher risk strategies as a result of going further up the risk curve. So this is where we have conservative algorithmic trading strategies. This is where Bitcoin also fits in as well. This is where our moderate trading strategies come in. Moderate and higher risk algorithms start to come in. And then the highest risk algorithms that do very well, but also have a higher risk of drawdown. And this is really something to understand, because if you want the higher returns, you must be willing to stomach the volatility. Now, when it comes to evaluating our algorithms here at Alvo Alpha, we have built an entire risk curve from low risk to high risk of softwares and strategies that may be suitable for users like yourself. As of March 2026, we currently have 5 live different trading algorithms that are all built for different risk appetites. So the data that I'm presenting here is based on historical data from the go live date of each one of these strategies up until March 13th, 2026. Now, the strategies range from 10% a year being our most conservative, all the way up to 300+% per year. The highest year that one of our softwares has actually done was 1,306% in 2025, and that was with our gold software. So when we look at the right-hand side here, when we look at the chart, you can see our strategies are graphed out based off of the monthly return, but also in parallel have their risk profile identified along the curve. So the left-hand side being the lowest risk, lowest return, lowest drawdown. The right side being the highest risk, highest return, highest drawdown. On the left-hand side, Alpha X doing about 1.88% per month. X drawdown was about 6.2%. Last year in 2025, it actually did 30% with a 5.1% drawdown. So pretty darn good year for Alpha X. With Intelligent Portfolio, does about 3.7% per month with about a 15% max drawdown ever experience. Alpha Trader, 4.19, and Crypto Alpha, max drawdown ever experience there was about 20%, 19.5 to be precise. And then once we get into our higher risk strategies that produce a very high return for a lot of users, now with Alpha X, we actually pair that with a funded account. We're actually able to lever up without having to actually put in more capital. So some of the users that have used that strategy have experienced about 18.8% per month. And last year, since Alpha X did 30%, he actually did over 300% return with this strategy with the funded account. Now, the max drawdown ever occurred on that, 62%. So it is a higher risk strategy, higher risk, higher reward, right? Same with the Gold Alpha. Gold Alpha has averaged about 27% per month. Last year in 2025, the drawdown only experience is 10.8%. But in 2026, we have seen a 60% drawdown once the Iran war broke out. Now, the software has recovered and has done well since then. But the point of me making this video is to show you guys a risk curve and what actually to expect as a result. So this is the expected drawdown for each type of asset that we look to potentially invest and allocate capital to. Cash, you're not going to have a drawdown, but you do have it depreciating on an annual basis. Bonds have experienced between 10 to 20% drawdown, and the expected annual return is only 4 to 5%. S&P, about 8 to 12% per year, still experiences 20 to 35% drawdowns. And you can go down overall, but if we head to the algorithmic trading side, once you start going into 2 to 3% per month, we're typically going to see between 10 and 20% drawdowns. The algorithmic trading moderate bucket, you're going to be seeing 20 to 40% potential drawdowns. Doesn't mean that it happens. A lot of our algorithms do have a lot of risk management baked into them, but this is the overall expectation as a result when you're looking at results and when you're looking at what the trade-offs are. So anything in the aggressive category, obviously 80% to 300% plus per year is more aggressive. Be willing to stomach 40 to 60% drawdown, and sometimes even more depending on the strategy. And that will allow you to have the right expectations going into a soft lift. Doesn't mean that this 100% will happen, but this is more of a table that gives you realistic expectations across all assets, what your expectations should be going into them. So I say all that because aligning goals and expectations is key. Every investment is a trade-off between risk and return, and algorithmic trading is not necessarily meant to replace all of your traditional assets. It's designed to complement them. And so just like any professional portfolio manager, the goal is diversification across strategies that perform well under current market conditions, to hold the strategy or hold the portfolio over a longer period of time. Now, we do have users that have allocated more to algorithms than other assets. So it may not represent a small portion of their portfolio. They may be more risk on. So each individual can make that choice for themselves, but we're here to provide algorithmic trading strategies and education for users to make that decision for themselves. So what we cover on our consult, if you're watching this prior to your call with our team, our intention is to align you with the strategy that fits your risk and drawdown that you are willing to accept. Now, many users may get started with multiple softwares with conservative and more aggressive, or users may go into just more aggressive strategies overall. So we want to ensure we understand your experience and level in the markets and in trading. We want to understand your capital allocation goals, the risk tolerance of drawdown expectations, which strategies, again, may be a great fit for your portfolio based on your goals, and that way you can see how the software and our ecosystem can work within your current allocations. Now, to be clear, our software strategies are designed to fully execute all trades on your behalf. And so, since you are in control of your funds with our program, you are in control of deposits, withdrawals, and even being able to turn off or on the strategy, you want to ensure that you have the confidence from understanding the overall thesis of what the softwares are designed to do. That way, you can make an informed decision, and we'll be more than happy to cover more of this stuff in depth on the call. So we look forward to seeing you there, and we hope that this video is insightful, educational, and has a better understanding of where algorithms may fit in your broader capital applications.